EU crisis uncertainty is limiting buying interest in the precious metals this Wednesday. Joining me to talk about this is Vince Lancy over at FMX Connect. Vince, so nice to see you again.
Good morning, Daniela. How are you?
Vince, last week when we spoke, you predicted the G20 meeting would be a non-event. It was. You also called for gold to fall out of the wedge, and it did. You sent me a new chart today. What are we looking at?
Yeah, we sent you a chart, but working from the most recent to the past. Let's start with the wedge. The wedge that Greg and I worked on, or that we saw, certainly did break down yesterday, but we were a little bit nervous that we didn't get confirmation on the volume in the washout, and the fact that we settled very close to the lower trend line on a relative basis gave us a little trepidation on the bear side. So moving forward from here, we're still biased bearish, but we would be concerned if the market touched 1678 or above that. So bearish, but not with a lot of momentum. On the upside, we would prefer to be buyers of dips, like a nice washout, but we would consider getting long above 1701 if it breaks the top of the trend line on the wedge. So that's where we are looking forward. We're becoming bearish to neutral with an eye on buying dips close to the 200-day moving average.
Vince, let's talk Greece now. There is the EFSF fund, which is the $440 billion Euro emergency fund designed to help Euro nations at risk. Would it be a good idea or a bad idea to help Greece out with this?
I don't know if it's a good idea or a bad idea, but I think it's probably important to possibly explain in more layman's terms what the EFSF is. It's thrown around a lot. It's the latest acronym on TV. I guess it's ranking probably number 2 behind QE3 or QE 2.5. A lot of people don't really know what it is. What it really is, first of all, is it's a $440 billion Euro insurance fund used in case of emergency. Now, that's fine in and of itself. Who puts the money in that? Germany, France, and other countries who have money have funded it over the years. What they're looking to do now, well, actually, first of all, this fund has senior status. So if listen to me, if the EFSF were to loan money to Greece and then Greece were to default, in its current situation, the EFSF would be last to lose money, which protects the sovereign nations that have invested the money in it. Now, the French particularly have wanted to, number one, leverage the EFSF, which is ridiculous. You're going to take a country that's basically bankrupt from borrowing and then lend them money and then leverage it. That would be like you taking a credit card, taking another credit card and paying it off with it, and then borrowing money against the credit card that's already been used. It doesn't make much sense. What happened is that as soon as there was talk of raising the leverage to $2 to $3 trillion off the $440 billion, there also was talk of making it first to lose, actually making the EFSF money junior to the private money. Now, why is that? It's because the private money is money invested in by French banks. So the French and Europe in general are playing a shell game. It's no longer kick the can down the road. It's hide the debt under a shell. If the EFSF throws money at Greece and is senior, then what ends up happening is the private companies would lose money first if Greece went bankrupt. That would mean French banks would take a hit, which would be bad for France. If the EFSF debt is junior to the other debt in Greece, then France's credit rating would take a hit because it would be sovereign losses. And that's what you saw. You saw the EFSF say, we're going to try and leverage this up to possibly $2 trillion. We're going to make it first loss money, meaning make it junior debt. And Moody's said, well, we're going to consider downgrading France. So now they've pulled back to $1.2 or $1.3 trillion leveraging. And I'm not really sure where they stand on the actual senior versus junior debt. But the whole idea is, where can we get this money to pay off the debt? And it doesn't exist.
Vince, you mentioned Moody's, and it looks like France is now on their radar. They're now putting its AAA rating on watch.
I think the France thing is a warning. They downgraded Spain, I think last night, a double downgrade again on the warpath. France would be next on their radar as a warning. To those people out there who look at Germany as the economic strength of Europe, bear in mind that 85% of Germany's GDP, 85% of that is debt. So they have an 85% debt ratio to GDP. If Germany were forced to recapitalize its banks, it would also be theoretically insolvent. So there's just nothing there. They have to print money eventually.
All right, Vince, let's talk about the next phase of the slow Greek default, as you call it. What would be in store for the dollar and gold?
Well, I think starting with the dollar and the euro, if I were a European bank, if I were a French bank, let's say, and I knew that Greece was going to default or I was worried about it, at the top, I would be telling my traders to short the euro to hedge our Greek exposure. And that's what they're doing right now. If I were a trader at that French bank, I'd be saying, crap, I'm long Greek bonds. I need to short the euro. So every time the euro rallies, European banks are selling the euro. They're shorting their own currency. So in the end, unless you have true resolution, which you're not, you're going to see the euro keep getting slammed, the dollar go up, and you'd like to see gold go up as an alternative safe haven. But that link has been broken for the last 2 months, and we're kind of sad about that. We think that link will reestablish itself as a safe haven when you do actually see a default. But right now, gold seems to be just tied strictly to the dollar. So no matter how bad Europe gets, as long as the dollar is strengthening, people are going to sell gold to raise cash. Go figure.
Okay, Vince, as always, enlighten us with some final thoughts for investors.
Everything that's coming out of Europe is noise until there's actual resolution. So, the keep your powder dry concept remains strong in the sense that the markets are whippy and the Europeans don't know what they're doing yet. So I would just be careful.
All right, Vince, thank you so much. We'll see you again next week. For Kitco News, I'm Daniela Cambone. Thank you for watching.